The bizarre math behind Tesla's valuations. It's an interesting article I'll share with you. And this this doesn't remind you of the late 90s. I don't know what will. Actually, let me minimize my screen here, and we'll dive right into this. From Advisor Perspectives, Dateline July 27, 2020, by my man who wrote the Vitaly Castanelson. I've read him a couple times before. Let's see what old Vitaly. He's a chief investment officer at Investment Management Associations in Denver, author of Active Value Investing and the Little Book of Sideways Markets. All right, and he's got a blog called Contrarian Blog. So I'm always interested in contrarian stuff. So, all right, let's read this. Tesla's market cap just crossed $300 billion. It is the largest automaker in the world, even larger than Toyota, which produced almost 9 million cars in 2019. But had a market capitalization of $200 billion. Tesla's market cap implies that its production will go up to more 20-fold from the 400,000 cars it produces today to 10 million. So think about it. Tesla produces 400,000 cars. Is a market cap 50% higher than that of Toyota, which produces 9 million cars. That doesn't make much sense. As the market evaluation of Tesla raced to the moon, its debt rating remained as junk, whereas Toyota's A+ and GM is BBB. The largest automaker in the world is junk rated and only has 400,000 cars in production. In the past, I've made the analogy that the transition from the ICE, the internal combustion engine, to electric motors is akin to the transition from dumb to smartphones. It's a domain shift. You gotta stop this. Every time I do a video, Pablo says, I want to be on it. Pablo likes to be on a camera. So maybe another domain shift will bring higher margins to Tesla, as happened for Apple and the iPhone. Unlike other car makers, Tesla is vertically integrated, which is good. It manufactures most of the components that go into its cars, including the seats. Thus, gains from the economies of scale that used to accrue to suppliers will accrue to Tesla. Also, software plays a bigger role in Tesla than a traditional car, which is kind of frightening. There's self-driving over-the-air updates, an iPad-like interface that powers all the controls. So advanced software helps Tesla get higher margins than the traditional car companies that may not have to make as many cars to get to Toyota's profitability. Bulls would even argue that self-driving alone may send Tesla's margins to the moon. Well, they're already the valuation's already at the moon. I'd like to pour cold water on that argument. Fully autonomous driving is a good decade away. I discuss in great detail here in his 37-page Tesla write-up, and you can link the show notes to this article, and you can leave that if you want. Let's just take a look at Tesla's. It's just weird to me. What is it? I don't even know what Tesla is. Right there. It's trading at 1476. It's got a PE of 764. I mean, look. Watch this. Look at that. From 2019 to now, you can see just it took off like a bat out of hell. Look at that, man. Let's go 2 years. Just look at that 2-year chart. With a PE ratio of 764. This reminds me of a lot of the 90s. Where it was like some of the companies, I can't remember what companies were worth more than like Exxon, Chevron, all the big oil guys combined. I forgot what it was. But anyway, most importantly, going from 400,000 cars to many millions a year is neither an easy nor cheap journey. The market confuses Tesla with other Silicon Valley tech companies. Yes, Tesla is much more a technology company than your typical ICE company. It creates its own software and even the microprocessor that powers self-driving. But it still cannot escape the reality that has to bend a lot of metal products to electric cars. Unlike Facebook, which could increase its user base by 10 to 20-fold by spending a few hundred millions on data centers, Tesla will require an incredible amount of capital to increase production. To produce fewer than 500,000 cars as it does today, Tesla needed $25 billion investment in property, plants, and equipment. And this is where bits meet atoms and face financial gravity. Tesla is barely breaking even today. It will need to raise and invest not just tens of billions, but hundreds of billions to increase its production. And then there is an element of time. Tesla has been stuck at producing 90,000 cars for the last 8 quarters. It can only blame the coronavirus for a quarter or two. Getting to an annual production of even a few million cars will require time, and a lot of it. A lot of dirt has to be moved, permits issued, and equipment installed, people hired. In Star Trek, there are convenient wormholes which cut corners through space, getting into that galaxy light years away. Low interest rates have messed with the temporal properties of the market and created a wormhole in time in Tesla's stocks. It will take years, maybe even a decade, for Tesla to produce enough cars to justify its valuation. Today's market valuation assumes that has already happened, that the capital has been raised and spent and it costs nothing. A few additional thoughts on the internal combustion makers. What is interesting to me is that today the market is basically valuing ICE makers as melting ice cubes. It tacitly assumes they won't be able to transition to electric vehicles, so it values only their ICE cash flows, giving them basically no terminal value for the overall business. Transitioning from one domain to another is incredibly difficult. Your assets turn into liabilities. Even your knowledge in the own domain is often liability in the new one. Just imagine being the best racehorse carriage maker in 1910 and making cars at the same time. Your horse carriages still provide huge cash flows, but you still have to come up with new, better horse carriages and market and advertise them. But at some point in that time, the business will be worth zero. This is the feeling I got when Chevy introduced this new Corvette. One route that might save the ICE industry is the standardization of the hardware that goes into cars. Think of smartphones. Most of the parts that go into them are standardized. The memory that goes into iPhones and Android phones is the same. So are the battery, sensors, and microprocessors. Apple develops its own, but most Android phones are powered by microprocessors designed by Qualcomm or Samsung. Software too. All Android phones, which are 80% of all software smartphones globally. Wow, Android phones are 80% of all smartphones globally. Run software created by Google. The standardization of components brings costs down substantially. Imagine if every smartphone manufacturer had its own version of everything that goes into a smartphone. Now think about the internal combustion engine. The only parts that are standard among cars are the tires and batteries. All the other parts, engines, transmission, running gear, are basically custom to each manufacturer and each brand. Toyota parts may or may not work in a Lexus, for instance. The best way to drive down costs of electric vehicles is to borrow the standardization approach from the smartphone industry. Tesla doesn't have this identity crisis to grapple with, nor does it have to make horse carriages while it's working on new cars. There are several significant differences between phones and cars, thus requiring a tweak to dumb phone and smartphone analogy. First, cars cost a lot more than phones. They could not agree more. Second, because functionality is so similar, most consumers driving internal combustion engine cars do not know what they're missing. Which brings me to the final point. The replacement cycle for phones is a year or two, but for cars is about 12 years. Exactly. Thus, the transition to electric vehicles will be gradual, giving internal combustion engine makers time to adjust. When I wrote my Tesla analysis, I opened up this quote from F. Scott Fitzgerald. The test of first-rate intelligence is the ability to hold two opposed views in mind at the same time and still retain the ability to function. You can see that analysis of Tesla in the automotive industry today requires a lot of opposing views, including that of Tesla's stock price depends on Elon's ability to maintain a temporal wormhole. Disclosure, I own a Tesla 3, Model 3, and I love it. I have a small position. Tesla puts the cake. I have a small position in Tesla puts in case the temporal, in case so he got put, so he's betting a little bit against it in case the wormhole collapses. Let's see what the comments are here. On the market for a car, no one can tell me how much a battery replacement costs, and the availability of parts out of warranty seems to be a mystery as well. And will I arrive at charging stations that are overwhelmed in 2 years? So there you go, man. Whatever. I don't understand. Let's just take a look at Amazon. The PE ratio of Amazon, of course, with the commie virus helped it immensely. Almost by design. Amazon PE. The reason I want to look at Amazon, because I remember when Amazon had a PE when it first made profitability of over 1,000. Amazon's trading at $3,000 a share with a PE ratio of 143. And there's the Amazon stock chart. I wouldn't buy Tesla to save my life, but all right, there you go. I hope you like that. Love to hear your comments. Thanks now.